Hi, everybody. My name is Nathan Dean, and I am a senior policy analyst with Bloomberg Intelligence here in the Washington, D.C. office. And just wanted to take you through a couple of things that are happening in Washington, especially as we are waiting to see the results of the New Hampshire primary and whether or not President Trump runs away with the nomination. But first, I want to start on the regulatory side. Last week was actually a big day, or at least it was a big day in last week. That was January 16th. That was the comment deadline for two proposals over at the Federal Reserve. The first one being known as the Basel III Endgame. Now, if you've watched some of the NFL games lately, you may have seen commercials on this, Stop Basel III Endgame. What they're talking about here is a proposal that is a recalibration of risk weighting of assets, and this would lead to about 19 to 20% higher capital requirements for the largest banks. Now, this is applicable to banks that are 100 billion and up, but a lot of the at least comment letters and so forth that you see are focused at the big bank level. Now, there are two key takeaways that Elliot Stein and I took away when we were reading these hundreds of pages of comments. And the first is on the operational side. Well, we think the Fed is going to have to drastically scale this rule back if they want to get it done this year. And we're still proceeding under the notion that they're going to get it done this year. That's a huge asterisk on that, though, because it's a heavy lift, and any major change in the proposal is going to take time. So don't be surprised if this also pushes off into 2025. But some of the changes that the Fed is going to have to do deals with three pillars of this recalibration: operational risk, credit risk, and market risk. Now, on the operational risk side, well, this is something that banks really haven't faced in the past. Some of the comments are like, look, we have this taken out through other things like stress testing and the GSIB surcharge. So we think that the Fed is going to have to do a little bit more work there. And I think they're going to have to do a little bit more work on the credit risk provisions, especially for the risk weighting of assets, or at least the risk weighting tied to certain things like consumer-facing loans, mortgages, credit cards, etc. Now, there's been some controversy, I don't want to say controversy, but there's some discord, if you will, on this credit risk provision and some of the more moderate Democrats up on Capitol Hill. And I think the Fed is going to have to make some changes to make those folks happy. Now, the other argument that we've heard from the industry on the Basel III Endgame is, look, we're going to sue you. There was even a letter that came out from a variety of trade associations calling into question the violations, if you will, of what is known as the Administrative Procedures Act. This is the rule that regulators must follow in order to propose, finalize a rulemaking, and get it into the books. Now, we've seen news stories, we've seen folks saying, look, that outside counsel has been hired and so forth like that. It's highly likely that the industry is going to sue the regulators once this is finalized, or if this is finalized. And many of the comment letters essentially pointed to that fact. So even if the regulators do come out with this year, chances are there's going to be a lawsuit, and then this could get even put into the courts over the next few years. So another thing we're going to talk about is what's coming up on January 24th. Now, I'm recording this on January 22nd. On Wednesday this week, the SEC is going to finalize a rule on SPACs, special purpose acquisition companies. And I'm going to pull up some data from the terminal right now just to show that even though this proposal is coming out, and this proposal is going to essentially solidify the frozen issuances of the SPAC market, this really isn't all that impacting, primarily because when this proposal was first released in January, or the first quarter of 2022, the numbers were much different than they were today. So in 2021, according to the Bloomberg data here, there were 70 transactions with $11.2 billion in volume. Today, there's 25 deals, and I'm sorry, this should be 2023, 25 deals and $3.12 billion in volume. So the SPAC market is not what it used to be. And this proposal, you may see some headlines about new governance and transparency and discovery and disclosures and so forth like that. But this proposal really is not going to have all that much impact because the market has cooled so much. Now, other things to note, last week, the Consumer Financial Protection Bureau put out its long-awaited proposal on overdrafts. We're going to be analyzing that this week. We should have that stuff out on the terminal later this week. But I also want to point out that we're still waiting for the CFPB to finalize their credit card late fee proposal. This is something that I think a lot of folks were anticipating towards the end of the year. Just keep in mind, it's highly probable that this is going to come out before the State of the Union on March 7th. So even if it doesn't get done in January, I would have to imagine it gets done in February, because I think there's a decent chance that President Biden is going to mention this in his remarks on March 7th. Last thing I want to talk about, government shutdown. Obviously, we did not have a government shutdown That has been pushed off to March 1st and March 8th. Again, the State of the Union being March 7th. I would just call out here is that Congress is not here all that much in February. In fact, I think there was only 3 days that both the House and the Senate are here at the same time. So it's not a ton of time for folks to be able to work together another deal. So don't be surprised if the can is kicked again. Nobody wants a government shutdown during a State of the Union, but you have this April 30th date laying out there. So if the government is still operating under a continuing resolution on April 30th, there's an automatic 1% sequester, and nobody in Washington wants that. So don't be surprised that even if this is the can is kicked one more time, Congress eventually comes to a deal. I know there's a lot of scary headlines, but for the market impact, just remember, scary headlines does not equate to scared markets. Even if you're in the contracting space, government shutdowns aren't all that much of a big deal. Something like the debt ceiling is a much bigger deal, and that has been pushed off to the end of, it's beyond the election season. So I'm going to wrap it up here. If you have any questions, as always, please feel free to reach out, and thank you very much for your time.